For years, California's rental market was unstoppable. Prices soared, demand outpaced supply, and tenants competed for apartments like lottery tickets. But in 2025, the tables have turned, and the landlords are the ones worrying. Across the Golden State, rental listings are piling up. Vacancy rates are climbing to levels not seen in a decade. The combination of rising construction, slowing migration, and sky-high living costs has triggered a correction few saw coming. According to Zillow and Redfin, California's statewide rental prices have dropped by an average of 6% this year, with some cities seeing double-digit declines. Luxury apartments that once commanded top dollar now sit empty for months. The result? Incentives, free months of rent, and desperate price cuts in cities that once symbolized unaffordability. Today on Discover the Nation, we revealed the top 10 California cities where the rental market is crashing fast and uncover what's really driving this sudden shift. And before we begin, make sure to subscribe and turn on notifications. Every week, we bring you data-driven stories about America's housing transformations, where numbers meet real lives. Let's begin.
Number 10, Santa Clarita. Just a short drive north of Los Angeles, Santa Clarita has always been Southern California's symbol of suburban perfection. Clean streets, excellent schools, and a promise of safety and family stability. For years, it was the dream alternative to LA's congestion and chaos. But in 2025, that dream is quietly unraveling. After years of expansion, Santa Clarita's rental market is cooling faster than anyone anticipated. Vacancy rates have climbed to 7.8%, the highest in nearly a decade. The median rent for a two-bedroom apartment, once topping $2,900, has plunged to around $2,250, with landlords cutting prices further each month just to stay competitive. Developers built aggressively during the pandemic boom, convinced that the exodus from Los Angeles would never end. Massive new complexes in Valencia and Canyon Country rose almost overnight, advertising luxury suburban living. But as remote work fades and companies call employees back to offices, many of those renters are gone. Rows of brand new buildings now sit half-occupied, their now leasing banners fading under the relentless California sun. Utilities are up nearly 20% year over year, insurance premiums have skyrocketed, and commuting from Santa Clarita to the LA Basin, once the price of a quieter lifestyle, now drains time and money. Even longtime residents are leaving, heading to more affordable inland cities or out of state entirely. For the first time in years, renters hold the power here. Landlords are offering incentives, free months, no deposits, flexible leases, something unheard of just 2 years ago. It's a stunning reversal for a city once defined by competition and scarcity. Santa Clarita hasn't lost its charm, but its housing equation no longer makes sense. If you want to understand where California's rental boom is truly cracking, subscribe, because Discover the Nation digs beyond the headlines to reveal the full story.
Number 9, Sacramento. California's capital city, Sacramento, once symbolized opportunity for renters fleeing the Bay Area's crushing prices. Between 2020 and 2022, tens of thousands of remote workers moved in, pushing rents up 40% in 3 years. Downtown cranes filled the skyline, luxury towers broke ground, and investors declared the city a new frontier of prosperity. But in 2025, the tide has turned. Vacancy rates have surged to 9.2%, and average rents are down 7% year over year. What was once a thriving migration hub has become one of California's most oversupplied rental markets. Developers overbuilt, expecting permanent population growth. They poured billions into high-end apartment complexes near the Capitol and along R Street. But the demand vanished as quickly as it came. Many Bay Area transplants who drove the boom have since left, some returning to offices in San Francisco, others moving out of state to cheaper metros like Boise or Austin. Now, downtown towers that once had wait lists are offering free rent for 60 days and move-in bonuses. Midtown sleek lofts, the same units that rented in hours in 2021, sit dark for months. Renters have regained leverage, and they know it. Even local households are feeling the strain. Utility costs have risen, property taxes are up, and inflation has eaten into disposable income. With fewer state workers commuting and offices still partially empty, the city's economic rhythm feels slower, quieter. Sacramento's market isn't collapsing, it's resetting. But for investors who bought during the fever pitch of 2022, it feels like a freefall. The capital city that once promised balance between affordability and growth now stands as a cautionary tale. Even strong markets crumble when optimism outpaces reality.
Number 8. Long Beach. For decades, Long Beach was the quiet success story of Los Angeles County, a coastal city that offered ocean views without Malibu's price tag. But in 2025, that story has changed. Vacancy rates have climbed to nearly 10%, the highest level since the aftermath of the Great Recession. Rents that once seemed unshakable are falling fast. The median two-bedroom apartment that fetched $2,750 in 2023 now averages around $2,400. And luxury high-rises downtown are cutting prices by hundreds just to compete. 2 months free and no deposit signs now hang where waiting lists used to be. Developers helped create the problem. During the pandemic boom, construction cranes lined the skyline as builders bet that coastal demand would never slow. But the return to office wave undercut that gamble. The hybrid workers who once filled these new towers are leaving, some heading back toward job hubs in LA, others leaving California altogether. Rising costs have deepened the strain. Property insurance premiums are up more than 20%. Utilities continue to climb, and local rent control rules have pushed smaller landlords to sell or pull units from the market. The result is a strange imbalance. Too many vacant luxury apartments and not enough attainable ones. Downtown nightlife is thinner. Ocean Boulevard's storefronts are turning over, and neighborhoods from Belmont Shore to Bixby Knolls are dotted with for rent banners that stay up far longer than they used to. For years, Long Beach was the accessible coast, the middle-class answer to Southern California's housing crunch. But affordability has vanished, and demand is slipping. What was once the stable link between Los Angeles and Orange County has become another symbol of California's rental reckoning.
Number 7. Oakland. For decades, Oakland carried the banner as the Bay Area's working-class alternative. Diverse, gritty, and full of opportunity. But in 2025, it's leading the region's rental collapse. Vacancy rates have surged past 10.5%, and average rents have dropped by 11%. The shift is stark. Luxury high-rises once filled with San Francisco commuters now stand half empty, their lobby lights glowing over vacant halls. Oakland's rental unraveling began with the tech layoffs of 2023. Thousands of workers who had flooded into the East Bay to escape San Francisco's cost of living suddenly left the region altogether. Hybrid work emptied offices, while crime and safety concerns accelerated out-migration. The city's downtown, once buzzing with new restaurants and nightlife, now feels subdued, a shadow of its pre-pandemic energy. Landlords are slashing rents by hundreds of dollars a month. Some offer free rent for the first quarter. Others include parking or gym memberships to attract tenants. But demand simply isn't keeping up. Even long-term renters are renegotiating leases, knowing they finally have leverage after years of relentless price hikes. At the same time, investors who banked on constant depreciation are facing rising maintenance costs, property taxes, and shrinking margins. Many smaller owners are selling off properties at a loss. What makes Oakland's downturn unique is that it's not just financial, it's psychological. The city's reputation for resilience has collided with a growing sense of uncertainty. Locals describe it as a confidence collapse. The cultural heart of the East Bay is still beating, but quieter, more cautious. Oakland's market correction may eventually stabilize, but for now, it represents a striking reversal, proof that even the cities that fueled California's boom are not immune to its reckoning.
Number 6. Los Angeles. For decades, Los Angeles seemed immune to market corrections. Its mix of entertainment, tech, and culture
kept demand endless. Until now. In 2025, even the City of Angels is feeling gravity's pull. Rental prices across LA County have fallen 8% year over year, marking the steepest drop since the 2009 financial crisis. Vacancy rates have crept above 7%, with some neighborhoods reporting double that. And it's not just downtown. Even the once untouchable West Side, where studios fetched $3,500 a month, now sees empty listings lingering at $2,800, with incentives attached. The cause? Outmigration. Since 2020, more than 200,000 residents have left Los Angeles County, lured by lower costs in Nevada, Arizona, and Texas. The pandemic's remote work boom gave people freedom, and they didn't come back. Meanwhile, developers kept building, convinced the city's allure would fill every high-rise. Instead, towers in Koreatown, Hollywood, and Culver City are half full. The oversupply has flipped the power dynamic. For the first time in over a decade, renters have options and leverage. Apartment managers are offering free months, waived deposits, and parking discounts just to compete. Open houses that once drew crowds are now eerily quiet. It's not just the luxury market either. Mid-tier neighborhoods like North Hollywood, Echo Park, and Long Beach are seeing similar slowdowns. The city's working class, already stretched by inflation, can no longer absorb these rents. Even longtime Angelinos describe it as surreal. A city that once priced out nearly everyone, now scrambling to attract tenants. Los Angeles isn't collapsing, it's resetting. But for landlords who ruled this market for years, it's a painful awakening. The glitz is still here. Palm trees, sunsets, and ambition. But the numbers tell a different story. In 2025, the rent capital of the West Coast is finally coming back to earth.
Number 5. San Diego. Few cities have symbolized California's coastal paradise quite like San Diego, with its golden beaches, year-round sunshine, and a reputation for endless demand. But in 2025, the nation's 8th largest city is waking up to an uncomfortable truth. Even paradise can overheat. Rents across San Diego County have fallen 7% in the past year, while vacancy rates have climbed beyond 8%, the highest since 2010. What's more alarming is where it's happening. Once red-hot neighborhoods like Pacific Beach, Little Italy, and Hillcrest are all cooling fast. Developers spent the past 5 years flooding the skyline with new luxury apartments, betting on high-income tenants from biotech and defense sectors. But inflation, high interest rates, and shrinking household budgets have slowed demand to a crawl. Those sleek coastal towers that once filled overnight are now offering move-in bonuses and rent credits just to stay afloat. The problem isn't just overbuilding, it's affordability collapse. With electricity bills and property insurance costs among the highest in the state, even well-paid professionals are downsizing or leaving altogether. Inland cities like Riverside, Temecula, and Murrieta are seeing an influx of former San Diegans chasing lower rent and shorter commutes. The shift is visible everywhere. Downtown used to pulse with new residents every month. Now leasing offices are quieter, and landlords are negotiating for the first time in years. "We used to have waiting lists," one property manager said. "Now we just have waiting." Even longtime homeowners are uneasy. Falling rents are slowing property appreciation and reshaping expectations for the city's economy. San Diego's rental correction isn't a collapse, it's a comeback to reality. After a decade of relentless price climbs, the city is recalibrating. The demand will return someday, but for now, the landlords are learning what renters knew all along. Even in paradise, the math eventually matters. If you want the real story behind the glittering skyline, subscribe, because Discover the Nation shows what happens when the market meets the moment of truth.
Number 4. San Francisco. No city defines the highs and lows of California's housing story quite like San Francisco. Once the epicenter of innovation and wealth, it's now ground zero for the state's deepest rental decline. Vacancy rates have soared past 11%, a number unthinkable a decade ago.
The median rent for a one-bedroom apartment has fallen from $3,750 to $3,200, with some luxury units going for less than they did in 2015. Downtown, once the beating heart of the tech world, feels hollowed out. Streets that buzzed with commuters now echo with emptiness, and the rhythm of the city has slowed to a whisper. The causes are layered. Remote work decimated the daily workforce, and tech layoffs stripped away tens of thousands of high-paying tenants. At the same time, developers converted underused office buildings into residential units, flooding the market with supply. What was meant to solve the housing shortage has, ironically, deepened the vacancy crisis. Entire districts, from Soma to Civic Center, tell the same story. Sleek glass towers with panoramic views sit half dark at night. Even iconic properties like Nema and 181 Fremont, once symbols of wealth and exclusivity, now offer move-in incentives and rent cuts that would have been laughed at 5 years ago. The city's rental decline isn't just economic, it's emotional. San Francisco was built on momentum, on the belief that innovation would always outpace risk. But in 2025, that optimism feels fragile. Residents describe a city in pause, beautiful, brilliant, but uncertain of its next act. Yet under the surface, something else is happening. Opportunity. For the first time in years, middle-income renters can actually afford to live in parts of the city again. Studios in Hayes Valley, once unattainable, are leasing at pre-2016 prices. San Francisco's identity is shifting, not dying, but evolving. The boomtown has hit bottom, and from here, the story will depend on whether the city can reinvent itself once again.
Number 3. Riverside. For years, Riverside represented hope. A haven for Californians priced out of the coast, a city where families could trade cramped apartments for space and sunshine. But in 2025, even the Inland Empire's stronghold is showing cracks. Vacancy rates have surged to 9.4%, and average rents are down nearly 10% year over year, an astonishing reversal for a region once called California's affordability firewall. Apartment complexes that were full to capacity just 2 years ago now flash "now leasing" signs across empty parking lots. Some developers have turned to billboards and social media ads, offering discounts unheard of in the past decade. The cause? Overbuilding and broken assumptions. During the pandemic migration boom, developers raced to meet what seemed like endless demand from Los Angeles transplants. New complexes rose across Moreno Valley, East Vale, and downtown Riverside, built on the belief that remote work would make the city a permanent magnet. But population growth stalled, remote work rolled back, and the very workers who once fled here for cheaper rent are now leaving California entirely. Even longtime locals are stretched. Property insurance costs and utility bills have climbed sharply, and job markets in logistics and warehousing, the region's bread and butter, have softened. When Amazon scaled back expansion, thousands of jobs vanished. Those ripple effects hit renters first. The irony is striking. Riverside, once seen as the solution to coastal unaffordability, now faces its own affordability paradox. Housing that's cheaper on paper, but unattainable in reality due to stagnant wages and rising expenses. Landlords are offering creative deals, waived application fees, free parking, flexible lease terms, anything to slow the vacancy spiral. Yet many complexes remain quiet, their pools shimmering in silence. The Inland Empire's promise of stability has turned into a lesson in fragility. Even in a market built on resilience, when optimism outpaces reality, the foundation can crack.
Number 2. San Jose. For years, San Jose stood untouchable, the jewel of Silicon Valley, the epicenter of innovation, and home to the highest rents west of Manhattan. But in 2025, even the tech capital of the world is struggling to fill apartments. Median rent in San Jose has dropped 12% year over year, while vacancy rates have surged above 10%, levels not seen in over 2 decades. For a region where demand once seemed infinite, the reversal is historic. The explanation reads like a blueprint of the new economy. Tech layoffs at giants like Google, Meta, and PayPal have emptied thousands of high-income households. Remote work remains entrenched, freeing employees from the Bay's brutal cost of living. And younger tech professionals, once the fuel of the rental market, are moving to cheaper innovation hubs in Austin, Denver, and Salt Lake City. The fallout is everywhere. Downtown's sleek towers, built during the 2017 to 2021 boom, now stand half-empty. Rooftop lounges sit unused, and co-working spaces echo with emptiness. Luxury complexes in Cupertino and Santa Clara are quietly dropping rents by $400 to $700 a month. Even the high-tech suburbs are feeling it. Once untouchable addresses like Mountain View and Sunnyvale are seeing for rent signs multiplying, a jarring image for cities that once had 2-year wait lists. But beneath the shock lies a profound shift. San Jose's housing market was built on perpetual optimism, the belief that the tech engine would never slow. Now, that faith has faltered. Investors are pulling back, developers are pausing projects, and local governments are grappling with falling tax revenue. For tenants, though, it's a long-awaited reprieve. Engineers and families who once paid $4,000 for modest apartments are finally seeing relief. The power dynamic has flipped, and landlords are negotiating again. San Jose's rental downturn is more than a market story, it's symbolic. It signals the end of an era when tech defined not just California's economy, but its identity. The region that built the future is now learning what it feels like to come back to Earth.
Number 1. Bakersfield. At the top of our list, and perhaps the most surprising of all, is Bakersfield, California's working-class stronghold and longtime affordability anchor. For decades, it was the last refuge for families priced out of the coast. But in 2025, even Bakersfield is facing an oversupply crisis that's rewriting its story. Vacancy rates have exploded past 12%, the highest in the state, and rents have dropped by 13% year over year. For a city that built its reputation on stability and affordability, the downturn is staggering. The roots trace back to the pandemic boom. Developers rushed to build thousands of new units, betting that migration from Los Angeles and Fresno would never slow. But as the economy cooled and population growth plateaued, demand evaporated. Entire new complexes now sit half-empty along the edges of town, their banners offering 2 months free and no deposit. Job losses have deepened the pain. Agriculture, one of Bakersfield's economic pillars, has been hit by drought, automation, and global price pressures. Logistics and oil, the other key industries, have also softened, leading many renters to pack up and leave the region entirely. The ripple effects are visible everywhere. Shopping centers are quieter, property managers are cutting rates, and neighborhoods once full of families are showing for rent signs on every other block. For landlords, it's a wake-up call. The safe market myth has vanished. Oversupply and economic fragility have collided, creating a perfect storm. Those who bought investment properties at the peak are now underwater, while local owners scramble to stay solvent. Yet beneath the hardship lies something profound. Bakersfield's market is rebalancing. The excess is clearing out, and for the first time in years, housing here is truly accessible again for working-class families. Still, the shift is symbolic. If even Bakersfield, the city that was supposed to be immune, is struggling with vacancies, then California's rental market correction isn't coming. It's already here. If you want to see where the state's housing story reaches its breaking point, subscribe. Discover the Nation brings you the truth behind America's changing economy, one city at a time.
From Fresno to San Jose, California's rental market is facing a reckoning. After years of surging prices and landlord dominance, the balance of power is finally shifting. Tenants have leverage again. Vacancies are rising. Incentives are back. And landlords are learning that endless demand was never guaranteed. This correction isn't just economic, it's cultural. It's changing who can live in California, where people move, and how cities will rebuild. The Golden State isn't losing its shine, but it's rediscovering what balance feels like. Thank you for watching Discover the Nation. If this story opened your eyes, subscribe, like, and share, because every week we uncover the real stories behind America's housing shifts, migration waves, and economic transformations. Because to understand the future, You have to follow. Where the rent's falling fastest,